What just happened in the silver market over the past 72 hours is unlike anything we've witnessed in over 4 decades. While mainstream financial media is calling it a crash, a panic, a bubble bursting, what you're actually watching is the beginning of the end of a fraudulent pricing system that has controlled precious metals for generations. And if you understand what's really unfolding right now beneath the surface, you'll realize this moment isn't the disaster everyone thinks it is. It's the greatest wealth transfer opportunity of this decade disguised as chaos. Let me walk you through exactly what happened, because the official narrative and the reality are 2 completely different stories. Silver hit an all-time record high of $122 per ounce on January 29, 2026. Think about that for a moment. Gold reached $5,000. The entire precious metals complex was experiencing historic gains. President Trump nominated Kevin Warsh as the next Federal Reserve chairman, and markets immediately understood what this signaled. Silver plummeted over 25% in hours, from $122 down to $78 in some markets. This wasn't a natural market correction based on fundamentals. This was a coordinated policy-driven sell-off triggered by one announcement. One person's nomination to lead the Federal Reserve sent shockwaves through every leveraged position in precious metals. But while paper traders were liquidating in panic, something completely different was happening in the physical market that reveals the truth about what's actually going on. Before we dive deeper into the mechanics of what just happened, let me be crystal clear about who Kevin Warsh is and why his nomination triggered this massive move. Kevin Warsh served on the Federal Reserve Board from 2006 to 2011. He was there during the 2008 financial crisis. He watched how the system responded with unlimited quantitative easing and unprecedented money printing. And he spent the 15 years since that crisis becoming one of the most vocal critics of those policies. Warsh has publicly called quantitative easing a reverse Robin Hood policy that enriched the wealthy while hurting everyone else. He's argued that the post-2020 inflation surge was a direct policy mistake, not an unavoidable outcome. Here's the part that terrified leveraged traders: rate cuts combined with balance sheet reduction. Let me explain why this is so significant. For the past decade and a half, every time the economy showed signs of weakness, the Federal Reserve responded with the same playbook: cut rates and expand the balance sheet. Lower rates and print more money, cheap borrowing costs and unlimited liquidity working together. This created an environment where asset prices could only go up as long as the money supply kept expanding. Stocks, real estate, cryptocurrencies, precious metals, everything benefited from this constant liquidity injection. But Warsh is signaling a fundamentally different approach. He wants rate cuts without the liquidity expansion. He wants discipline on the balance sheet, even as borrowing costs come down. This represents a complete regime change from everything markets have been conditioned to expect since 2008. If quantitative easing truly is ending, if the era of unlimited money printing is over, then highly leveraged positions built on the assumption of constant liquidity expansion are suddenly at extreme risk. And that's exactly what we saw play out in the silver market. Traders who were leveraged 40-1, speculators who assumed the Fed would always print more money to bail out the system, investors who believed rates would come down alongside expanded liquidity, they all rushed for the exits simultaneously. Margin calls went out. Stop losses were triggered. Forced liquidations cascaded through the system. And silver, which had been the most spectacular performer with its 270% gain in 12 months, experienced the most violent correction. But here's where the story gets fascinating. Because while Western paper markets were experiencing this historic sell-off, China was doing something completely different. And this divergence is the key to understanding what's really happening and what comes next. Shanghai silver premiums, the difference between what physical silver costs in China versus what paper contracts trade for in New York or London, remained elevated throughout this entire crash. When silver was trading at $122 in New York before the crash, Shanghai was paying a $17 per ounce premium. That's roughly a 14% premium for physical metal. Then, when New York crashed to $78, Shanghai didn't follow proportionally. The premium actually expanded in percentage terms, showing that physical buyers in the world's largest manufacturing economy were not panicking. They were accumulating. China understands something that Western paper traders are only beginning to grasp. Physical silver cannot be printed into existence by central bank policy. There's a finite amount of silver in the world, and an increasing percentage of it is being consumed in applications that don't return it to the market. Solar panels, electric vehicles, semiconductors, artificial intelligence infrastructure, nuclear reactor components. All of these technologies require silver, and once that silver is used in manufacturing, it's effectively gone from the available supply. This creates a structural deficit that no amount of paper contract manipulation can solve forever. And China has been quietly positioning for this reality while Western markets play derivative games. Now, let me share something that should wake you up to what's happening in the physical market, because while prices were crashing in paper markets, the actual metal was experiencing something very different. China's Securities Times, one of their major financial publications, reported that trading in the country's only pure-play silver exchange traded fund, the UBS SDIC Silver Futures Fund, was completely suspended on Friday, January 30th. This marks the second full-day halt for the fund since January 22. Why would Chinese regulators completely shut down trading in a silver fund during a massive price crash? Because the premium of that fund over its net asset value had exploded to over 60%. Think about what that means. Investors were so desperate to get exposure to silver that they were willing to pay 60% more than the actual value of the underlying assets just to own shares in the fund. Does that sound like panic selling to you? Does that sound like investors who think silver is finished? Or does it sound like investors who understand that physical scarcity is real and paper prices are increasingly disconnected from reality? Chinese regulators didn't shut down the fund to protect investors from losses. They shut it down because the speculative frenzy had become so intense that the fund's price bore no relationship to its holdings. And this happened during a crash in Western paper markets. The disconnect between paper and physical has never been more obvious. Let me give you some context about what's been happening in China's silver market over the past several months, because this crash didn't happen in a vacuum. Starting in October 2025, Chinese silver exchange traded funds saw net inflows of 491 tons. Total holdings reached 26,263 tons. Since October, the price sensitivity to these ETF flows has been measured at 13.6%, which explains roughly 65% of the 130% increase in silver prices since early October. Social media in China has been exploding with silver content. The phrase silver investing has been trending on multiple platforms. Retail investors who missed the gold rally have been piling into silver as an alternative way to hedge against currency debasement and economic uncertainty. And here's something absolutely critical that happened on January 1st, 2026, that changes the entire global silver market. China implemented export licensing requirements for silver. As of the first of this year, any company wanting to export silver from China must obtain approval from the Ministry of Commerce. This isn't a temporary measure. These controls are expected to remain in place through at least 2027. Why would China, the world's dominant player in silver refining and a major producer, suddenly restrict exports of this metal? Because they've officially classified silver as a strategic critical mineral, not just a precious metal for investment, not just an industrial commodity, a strategic material critical to national security and technological advancement. When governments start treating materials as strategic resources and implementing export controls, that's a signal that scarcity is real and becoming more severe. China did this with rare earth elements. They did it with tungsten. They did it with antimony. And now they're doing it with silver. Each time they've restricted exports of a critical material, global prices eventually surged as the rest of the world scrambled to secure alternative supplies that don't exist in sufficient quantities. The silver export restrictions haven't fully impacted global markets yet because there are still inventories and stockpiles that can meet demand in the short term. But over the next 12 to 24 months, as those stockpiles deplete and industrial demand continues growing, the impact of China controlling the supply will become impossible to ignore. If this deep dive is giving you a completely different perspective on what's really happening in silver markets, do me a favor right now. Leave a comment below telling me where you're watching from and what your biggest question is about these markets. I read every single comment, and your questions help me create content that actually serves you. No sales pitch, no hidden agenda, just real analysis to help you understand what the mainstream financial media won't tell you. Now, let me connect the dots between China's export restrictions, Western paper market crashes, and what this means for industrial demand going forward. Because the narrative that silver crashed because demand is weak couldn't be further from the truth. Industrial demand for silver is accelerating, not declining. The artificial intelligence boom is creating unprecedented demand for semiconductors, and silver is essential in semiconductor manufacturing. Data centers powering AI applications require massive amounts of silver in their electrical components. The global push toward renewable energy, particularly solar power, continues driving silver demand, even though growth rates have moderated from earlier projections. Electric vehicles use significantly more silver than traditional combustion engine cars. But here's something most investors don't know about that's going to drive silver demand to levels nobody is prepared for. Nuclear power is experiencing a renaissance, and nuclear reactor control rods require silver. We're not talking about small amounts. We're talking about industrial scale consumption. Goldman Sachs estimates that if nuclear power were to cover the entire incremental power demand from data centers between 2023 and 2030, the world would need to add approximately 85 to 90 gigawatts of new nuclear capacity. That's roughly equivalent to 60 to 90 large reactors. China has approved about 10 new reactor units per year for 2 consecutive years. In early 2024, they greenlit additional projects that are expected to start construction around 2026. India, Turkey, and Poland are all pushing nuclear plans forward. BloombergNEF estimates that 15 new reactors will start construction worldwide in 2026, adding about 12 gigawatts of capacity. The European Union is moving as well, with the European Commission planning to release an official small modular reactor strategy in the first half of 2026. This nuclear renaissance is happening because artificial intelligence and data centers require baseload power that's reliable 24 hours a day, 7 days a week. Solar and wind can't provide that. Only nuclear and fossil fuels can. And with the push to decarbonize, nuclear is the only realistic option for clean baseload power. Every one of these reactors requires silver. And unlike silver used in jewelry or coins that can be melted down and recycled, silver used in nuclear applications is effectively consumed. It doesn't return to the market. This creates a permanent reduction in available supply that compounds over time. So when you hear that silver crashed 25% and mainstream media calls it a bubble bursting, ask yourself this question. If industrial demand is accelerating, if China is restricting exports because they've classified it as a strategic material, if nuclear power is experiencing a renaissance that will consume unprecedented amounts of silver, why would the price crash? The answer is simple. Paper markets and physical markets are two completely different things. Paper can be created infinitely through derivative contracts. Physical metal cannot be conjured into existence by financial engineering. And right now, we're watching the paper market price silver as if demand is collapsing, while the physical market is showing extreme scarcity. Let me share some numbers that illustrate just how disconnected these two markets have become. When silver hit its record high of $122 on January 29th, the trading volume was absolutely unprecedented. Monday, January 27th, saw record trading volumes, followed by even higher volumes on Tuesday. Chinese fund managers were closing silver funds to new buyers, citing the need to protect investors from the significant premiums over net asset value. On Wednesday, more trading halts. By Thursday, the frenzy had reached such intensity that when the crash came on Friday, it was like a dam breaking. But here's what's crucial. The crash in paper prices hasn't changed the physical fundamentals one bit. The Shanghai Futures Exchange vaults are still draining at an accelerating pace. Total silver inventories at the Shanghai Futures Exchange declined to just 455 metric tons as of the last reported data. That's approximately 14.6 million ounces. For context, global silver investment demand alone is measured in hundreds of millions of ounces annually. The vaults that are supposed to back futures contracts are holding a tiny fraction of the metal that's supposedly traded on paper every single day. And this inventory is declining, not growing. Physical metal is moving from west to east at an accelerating pace. London silver holdings, which represent the heart of the global physical trading network, fell significantly in 2025 as metal was exported to meet demand elsewhere. Here's something that will shift your entire perspective on this crash. While Western traders were panicking about Kevin Warsh and dumping paper contracts, sovereign wealth funds and central banks were watching very carefully. The Czech foreign minister recently met with United States officials, specifically to discuss critical mineral supply chains. Silver was on that agenda. When government ministers are flying to other countries to discuss mineral supply security, that's not happening because there's abundant supply. That's happening because scarcity is becoming a national security issue. Critical minerals become subjects of diplomatic negotiation when countries realize they don't control enough supply to meet their strategic needs. And silver is now officially in that category for multiple governments worldwide. Let me address something important before we go further, because there are two completely different ways to approach what just happened, and you need to be crystal clear about which approach matches your situation. Some of you watching this are long-term physical holders. You buy actual metal, you store it securely, and your time horizon is measured in years or decades. When you saw silver crash 25%, you weren't panicking. You might have actually been excited because you view this as a temporary discount on real money. Paper price movements are largely noise to you. You're accumulating tangible assets that cannot be printed by central banks, and short-term volatility doesn't change your thesis. But some of you are active traders. You're managing positions in futures contracts or mining stocks or silver ETFs. For you, this kind of volatility is extremely dangerous if you're using leverage. A 25% move in a single day will absolutely destroy leveraged positions. Margin calls don't care about long-term fundamentals. If you can't meet the margin requirement, your position gets liquidated at exactly the wrong time. Both approaches, long-term physical holding and short-term trading, are valid. but you need to be honest with yourself about which one you're actually doing. If you're a long-term holder but you're using leverage to try to maximize short-term gains, you're going to get wrecked in this volatility. If you're a short-term trader but you refuse to use stop losses because you believe in the long-term thesis, you're also going to get wrecked. Clarity about your strategy and your risk tolerance is everything in this environment. The worst possible position is being unclear about which approach you're taking and getting caught in the middle when volatility explodes. Now let me walk you through the technical sequence of what happened, because this crash didn't come out of nowhere if you were paying attention to market structure. Silver had been in an almost parabolic rally since October 2025. From approximately $76 at the start of January, the metal surged to $122 by late January. That's roughly a 60% gain in less than 4 weeks. Momentum was extreme. Speculative positioning was at historic highs. Sentiment was euphoric. Every technical indicator was showing overbought conditions at levels rarely seen in any market. When Kevin Warsh was nominated as Fed chair on Friday, January 30th, it provided the catalyst that triggered profit-taking and forced liquidation. Traders who had been holding positions hoping for even higher prices suddenly reassessed their risk. If the Fed is going to practice balance sheet discipline instead of unlimited money printing, does the case for much higher precious metals prices in the near term still hold? Leveraged speculators who were banking on continued easy money policies decided the risk-reward had shifted. Sell orders hit the market. Once selling started, it created a cascade. Stop losses were triggered. Margin calls went out. Funds that were overweight precious metals had to reduce positions to manage risk. Algorithmic trading systems that follow momentum saw the downside acceleration and added to selling pressure. In a matter of hours, silver went from $122 to under $80 in some markets. Gold dropped from over $5,000 to below $4,900. The speed and magnitude of the move was historic. For silver specifically, this represented the worst single-day performance since March 1980, when the Hunt brothers' attempted corner of the silver market collapsed. But here's the critical difference between now and then. In 1980, the Hunt brothers were trying to manipulate the market through massive speculative positions. When their scheme unraveled, it was truly the end of a bubble with no fundamental support. What's happening now is completely different. The fundamentals supporting higher silver prices haven't changed. Industrial demand is real and growing. Supply is constrained and becoming more constrained with China's export restrictions. Central banks globally are diversifying reserves away from dollar exposure. The case for owning physical precious metals as a hedge against currency debasement and geopolitical uncertainty is as strong today as it was before the crash. What changed is sentiment and leverage, not fundamentals. And that's why this crash represents opportunity for those who understand the difference. Let me share something that most mainstream analysts are completely missing in their coverage of this crash. While silver was falling 25% in paper markets, the cost to borrow physical silver, measured by lease rates, remained historically elevated. 1-month lease rates for silver were at 6.6%. For context, during normal market conditions, silver lease rates are typically below 1%. When lease rates spike to these levels, it indicates physical tightness in the market. Banks and institutions that need actual metal to deliver on contracts or meet obligations are paying significant premiums to borrow it. This doesn't happen when there's abundant supply sitting in vaults waiting to be traded. This happens when the physical market is stressed and actual metal is hard to source quickly. So we have a situation where paper prices crashed 25%, supposedly indicating massive oversupply and collapsing demand, while simultaneously the cost to borrow physical metal is at multi-year highs, indicating physical tightness. These two signals cannot both be accurate. Either the paper market is correctly pricing abundant supply and the elevated lease rates are meaningless, or the paper market is disconnected from physical reality and the lease rates are the true signal. Given everything we know about industrial demand, China's export restrictions, declining inventories, and sovereign interest in securing supply, which interpretation makes more sense? Here's something else that's being completely ignored in mainstream coverage. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, compressed significantly during silver's rally and then expanded again during the crash. Before the recent surge, the ratio was around 70-1, meaning it took 70 ounces of silver to equal the price of 1 ounce of gold. At silver's peak of $122 with gold at around $5,000, the ratio compressed to roughly 41-1. After the crash, with silver at $80 and gold at $4,900, the ratio expanded back to around 61-1. Historically, this ratio has averaged much lower in the 15 to 20-1 range over centuries. During periods of monetary stress, or when industrial demand for silver is strong relative to gold, the ratio compresses as silver outperforms. If we're entering a period where industrial demand for silver continues accelerating due to the artificial intelligence boom, renewable energy infrastructure, and the nuclear renaissance, while gold remains primarily a monetary metal with limited industrial use. The structural case for ratio compression remains intact. A crash driven by leverage and sentiment doesn't change that structural dynamic. It just creates a better entry point for positioning ahead of the next leg higher. Disclaimer: nothing in this analysis constitutes financial advice. I'm sharing my perspective on market events and the information I've gathered from public sources. You are responsible for your own investment decisions. Precious metals are volatile. Leverage magnifies both gains and losses and can result in complete loss of capital. Never invest money you cannot afford to lose. Do your own research and consult with qualified financial professionals before making any investment decisions. Now let me address the bearish case directly, because I'm not here to pump hopium or tell you everything is perfect. There are real risks you need to understand. Momentum has shifted from bullish to bearish in the short term. If Kevin Warsh actually follows through on balance sheet discipline while cutting rates, we could see a prolonged period where liquidity remains tight, even as borrowing costs come down. That's a challenging environment for all risk assets, including precious metals. The era of unlimited quantitative easing might genuinely be over. Markets haven't had to function without that backstop for 15 years. The adjustment period could be longer and more painful than many expect. If you're trading with leverage in this environment, understand that volatility of this magnitude will destroy capital. Margin requirements have likely increased significantly after this move, meaning you need more cash to maintain positions. The next wave of selling could push prices even lower if macro sentiment continues deteriorating. These are real risks that deserve serious consideration, but here's why the bearish case for paper doesn't invalidate the bullish case for physical. China's export restrictions are real and will tighten global supply over the next 12 to 24 months. Industrial demand from artificial intelligence, data centers, electric vehicles, and nuclear power is accelerating, not declining. Shanghai vaults continue draining even as Western paper prices crash. Central banks globally are diversifying away from dollar dependence, creating sustained bid for alternative reserve assets, including silver. Governments are treating silver as a strategic, critical mineral and holding diplomatic meetings about supply chain security. These fundamental drivers haven't changed because paper traders got liquidated. Physical scarcity is real. Government recognition of strategic importance is real. Industrial consumption that permanently removes silver from available supply is real. The disconnect between paper pricing and physical reality is now wider than it's been in decades, possibly ever. And when disconnects this extreme persist, they eventually resolve. The question is not whether they resolve, but how and when. History shows that physical reality always wins eventually. Paper markets can stay irrational longer than most traders can stay solvent, which is why leverage is so dangerous. But the laws of supply and demand cannot be permanently suspended by financial engineering. Here's what comes next, and this is the part you need to pay very close attention to. In the short term, probably the next few weeks to months, sentiment will likely remain bearish. Mainstream media will run stories about the silver bubble bursting. Technical analysts will point to broken support levels and damaged chart patterns. Traders who got liquidated will share horror stories about their losses. This is all part of the emotional cycle that follows every major correction. But while sentiment is bearish and attention has moved elsewhere, something else will be happening quietly. Physical buyers will be accumulating. Long-term holders will be adding to positions at prices they haven't seen in months. Industrial users will be locking in supply contracts. Countries will be negotiating access to physical metal for strategic reserves. The Western paper markets will continue their manipulation games, creating and destroying paper contracts that have no relationship to physical reality. And China will continue quietly draining vaults, implementing export restrictions, and positioning themselves as the dominant force in physical price discovery. The war of exhaustion that I talked about earlier hasn't ended. It's actually accelerated. China doesn't need explosive moves higher that create attention and panic. They need steady accumulation at prices the West considers reasonable while restricting outflows through export controls. They need Western paper markets to keep playing their games while physical metal moves east. They need time for global inventories to decline to levels where the paper manipulation becomes impossible to maintain. And that's exactly what's happening. Every ton of silver that moves from London to Shanghai is one less ton available to meet Western demand. Every month that China's export restrictions remain in place is one more month of tightening global supply. Every new nuclear reactor that gets approved is additional permanent demand that cannot be met by existing supply. The fundamentals are working in favor of physical holders with long time horizons. The paper crash has created better entry points and shaken out weak hands. When the next leg higher begins, and it will begin when the market is ready and conditions align, the move will likely be even more powerful than what we just saw. Because now there are fewer leveraged speculators who will sell at the first sign of resistance. There are more physical holders who understand the game. And there's less available physical metal to meet the demand that will come. Three key takeaways as we wrap this up. First, what just happened was a paper market crash driven by leverage, sentiment, and a policy announcement. It was not a fundamental change in the case for owning physical silver. Industrial demand continues growing. Supply continues tightening. China's strategic positioning continues advancing. The disconnect between paper and physical has actually widened, not narrowed. If you're a long-term physical holder, this crash changes nothing about your thesis. If you're a trader, this volatility should be a wake-up call about the dangers of leverage in fast-moving markets. Second, Kevin Warsh as Fed chair represents a potential regime change in monetary policy, but the implications are more nuanced than markets are pricing. If balance sheet discipline really is coming while rates still get cut, that's bearish for highly leveraged speculative positions, but potentially bullish for hard assets that benefit from currency debasement concerns without needing constant liquidity expansion. The end of unlimited quantitative easing, if it actually happens, doesn't make the case for owning physical precious metals weaker. It potentially makes it stronger by forcing the system to confront the consequences of 50 years of fiat currency manipulation. Third, China's war of exhaustion in the silver market is working exactly as designed. Shanghai premiums remain elevated. Export restrictions are in place. Vault inventories continue declining. Industrial demand continues growing. And while Western traders fight over paper prices that swing wildly based on sentiment, China is quietly securing physical supply and positioning to be the dominant price setter when the paper market's credibility finally breaks. That's the end game. That's what long-term physical holders understand that short-term paper traders miss. And that's why this crash represents opportunity for those with the conviction and capital to act, while others are fearful. The great silver disconnect of 2026 is accelerating, and understanding the magnitude of what's happening requires looking at the bigger picture. Let me give you some additional context that ties everything together and shows you why this moment is so significant. Over the past year, silver has dramatically outperformed almost every other asset class, from approximately $30 in early 2025 to $122 at the peak. That's a gain of over 300% before the recent crash. Even after falling to around $80, the metal is still up roughly 165% from where it started just 12 months ago. Compare that performance to traditional assets. The stock market had a decent year, but nothing close to triple-digit percentage gains. Real estate remained relatively flat in most markets. Even gold, which had an exceptional year reaching $5,000, gained approximately 66%. Silver's performance before the crash was absolutely extraordinary by any historical measure. And this wasn't happening in isolation. It was happening against a backdrop of accelerating industrial demand, tightening supply, and governments recognizing the strategic importance of the metal. The solar energy sector alone has been consuming massive quantities of silver for photovoltaic cells. Each solar panel requires approximately 20 grams of silver. Global solar installations have been growing at double-digit percentage rates annually. As countries push toward renewable energy targets and attempt to reduce carbon emissions, solar deployment is expected to continue accelerating. That's permanent demand that removes silver from the available supply pool because the metal does not get recovered when panels eventually fail. It's effectively consumed. Electric vehicle manufacturing creates similar permanent demand. The average electric vehicle uses approximately 25 to 50 grams of silver in various electrical components, sensors, and battery management systems. As the automotive industry transitions from internal combustion engines to electric powertrains, this represents a structural increase in silver demand that grows every year with increased EV adoption rates. Now, layer on top of that the artificial intelligence revolution. Data centers powering AI applications are being built at unprecedented scale. Microsoft, Google, Amazon, Meta, and dozens of other technology companies are investing hundreds of billions of dollars in AI infrastructure. Every one of these data centers requires massive amounts of electrical infrastructure where silver plays a critical role. The conductivity properties of silver make it irreplaceable in certain high-performance applications. And the AI boom is just beginning. Current estimates suggest AI-related electricity demand could grow by several 100% over the next decade. That's sustained, growing, permanent demand for silver that most market participants haven't fully appreciated yet. Then we have the nuclear renaissance that I mentioned earlier. This deserves even more emphasis because the implications are enormous. For decades, nuclear power was out of favor in many Western countries, following accidents like 3 Mile Island, Chernobyl, and Fukushima. Environmental groups opposed it. Governments were hesitant to approve new projects. Existing plants were being shut down in some countries. But artificial intelligence has completely changed the calculus. These data centers need reliable baseload power 24/7. Renewable energy like solar and wind can't provide that consistency. Battery storage isn't economically viable at the required scale. The only realistic options are nuclear power or fossil fuels. With the push toward carbon neutrality, Nuclear is the only choice that meets both reliability and emissions requirements. Countries worldwide are reversing decades of anti-nuclear policies almost overnight. Small modular reactors, which are safer and more flexible than traditional large reactors, are being fast-tracked for approval. The technology has advanced significantly, making modern reactors far safer than earlier generations. And every single one of these reactors needs silver for control rods and various electrical components. We're talking about potentially hundreds of new reactors globally over the next 10 to 15 years. The silver demand from this sector alone could absorb a significant percentage of annual mine supply. Here's something else that most people don't realize about silver supply dynamics. Unlike gold, where approximately 70% of demand is investment in jewelry that can be recycled back into supply when prices rise, silver's demand profile is very different. Roughly 60% of silver demand is industrial consumption, where the metal is either destroyed, dispersed, or becomes economically impractical to recover. When silver is used in a solar panel that gets installed on a roof for 25 years, that silver isn't coming back to the market, even if prices go to $200 per ounce. When silver is used in electrical contacts that get thrown away in electronic waste, recovery rates are very low because the quantities in individual devices are tiny even though the aggregate is massive. This means that rising prices don't bring back supply the way they do with gold. When gold hits $5,000, people sell grandmother's jewelry. Old coins come out of drawers. Central banks that hold thousands of tons can sell if they choose. The supply response to higher prices is relatively elastic. But with silver, the majority of the metal is locked up in applications where price is irrelevant to recovery. It's gone. This creates a fundamentally different supply-demand dynamic that becomes more pronounced the higher the percentage of industrial consumption grows. And industrial consumption as a percentage of total silver demand has been rising steadily for decades. China recognized all of these dynamics years ago and positioned accordingly. While Western investors were chasing the latest technology stocks or cryptocurrency fads, China was systematically building the world's dominant position in silver refining infrastructure. They're not just a major producer of newly mined silver. They control the refining capacity that processes silver from all sources globally. This gives them enormous leverage over the entire supply chain. When they implemented export restrictions on January 1st, 2026, it wasn't an impulsive decision. It was the culmination of years of strategic planning to secure control over a critical resource before the rest of the world recognized its full importance. And here's what makes China's position so powerful. They have the world's largest manufacturing economy, which means they have the highest domestic industrial demand for silver. They have the refining infrastructure to process global supply. They have implemented export restrictions to prevent metal from leaving the country. And they have buyers who are willing to pay significant premiums over Western paper prices to secure physical metal. This combination of factors creates a situation where China can effectively set the physical price for silver independently of what happens in London or New York paper markets. The Shanghai premium isn't a temporary anomaly. It's the early stage of a permanent structural shift in where price discovery actually happens. When you step back and look at all these factors together, the crash that just happened in Western paper markets looks very different. It wasn't the market saying silver demand is collapsing or supply is abundant. It was leveraged speculators reacting to a policy announcement about Federal Reserve leadership, while the underlying fundamentals remained completely intact. Physical buyers understood this, which is why Chinese investors were paying 60% premiums even as Western traders were liquidating in panic. The disconnect between paper sentiment and physical reality has never been wider. And historically, when disconnects this extreme develop, the resolution always favors physical reality eventually. One more thing I want to emphasize before we conclude. The Kevin Warsh nomination and what it signals about Federal Reserve policy is actually more supportive of the precious metals thesis than markets initially recognized. If the era of unlimited quantitative easing is truly ending, if central banks are going to practice discipline on balance sheets even while cutting rates, that doesn't make fiat currencies stronger. It potentially makes them weaker in a different way. Without the ability to print unlimited money to paper over problems, governments will have to confront structural issues they've been avoiding for decades. Debt levels that are unpayable, entitlement programs that are unfunded, military commitments that are unsustainable, trade deficits that are chronic. All of these problems have been managed through monetary expansion for the past 50 years. If that tool is no longer available or becomes politically unacceptable, the adjustment process will be painful and potentially chaotic. And in environments of structural adjustment and economic uncertainty, hard assets with thousands of years of monetary history tend to perform well. The case for owning physical gold and silver doesn't depend on unlimited money printing continuing forever. It depends on fiat currencies being inherently unstable over long periods and governments being inherently prone to policies that debase purchasing power. Whether that debasement happens through direct money printing or through other mechanisms, The outcome for currency holders is the same: loss of purchasing power over time. Physical precious metals offer a way to opt out of that system, to store wealth in a form that cannot be debased by policy decisions, to hold assets that have retained value across centuries, and empires and monetary regimes. The thesis hasn't changed because paper markets crashed 25%. If anything, it's been reinforced by watching how quickly confidence can evaporate and prices can swing when leverage unwinds. Paper is fragile. Physical is permanent. The crash just reminded everyone of that fundamental truth in the most dramatic way possible. So as you think about how to position yourself going forward, remember these key points. Paper and physical are diverging at historic rates. Western markets crashed 25%, while Chinese buyers maintained aggressive premiums, and regulators had to halt trading due to excessive demand. Industrial demand from artificial intelligence, nuclear power, solar energy, and electric vehicles continues accelerating regardless of short-term price movements. China has implemented export restrictions and controls the global refining infrastructure, giving them enormous leverage over physical supply. Governments worldwide are recognizing silver as a strategic critical mineral and holding diplomatic discussions about supply chain security. Vault inventories continue declining, even as paper prices suggest abundant supply. And through it all, one truth remains constant. Physical assets cannot be created by central bank decree. Paper promises can be conjured infinitely through financial engineering, but real metal must be mined from the earth, refined through industrial processes, transported across borders, and stored in secure facilities. The supply is finite. The demand is growing. The disconnect between perception and reality is at historic extremes. Choose wisely which side of that equation you want to be on. Position based on evidence, fundamentals, and clear understanding of the difference between paper and physical, not based on fear, emotion, or short-term price movements that are driven by leverage and sentiment rather than supply and demand. Time will reveal who understood the game and positioned accordingly. The opportunity is here now. Make your decision before the window closes and the next phase begins.